Hey guys, how's it going? It's Andy from Magoo Investing. Happy Tuesday. In today's video, we're going to follow kind of a similar trend as what we did yesterday. In yesterday's video, I talked about 5 stocks that you guys recommended, and I tried to pick a variety of stocks. I picked one stock that I was a big fan of, 3 that were blue chip stocks, and then the last one was a stock that had huge upside potential. And based off of some of these stocks that you guys have recommended, today's video, I'm going to be talking about 5 cheap stocks that I could consider buying going into 2021. And when I say cheap, for some reason, a lot of people associate cheap with just being a low dollar amount. When I talk about cheap, I'm talking about a discount. Similar to how if we talked about a $30,000 car and you found it for $20,000, that would be cheap in comparison. So we're talking about in comparison to how the stock has performed this year. So these are all stocks that you can buy at a discount right now that could have big upside potential going into 2021. Also, if there are any stocks that you guys would like me to go over in a future video, I love hearing what you guys want me to talk about, and it gives me a lot of inspiration for the topics that I can make for these videos. So let me know what stocks you guys would like me to talk about in the comment section down below. So the big news that happened on Monday is that Tesla was finally included in the S&P 500, which had these stocks shoot up around 9 to 10%. The main reason behind this is because many of the index funds out there are required to own a certain amount of all of the stocks that are included in the S&P 500. And so since it's been included that, there was a lot of buying pressure and the stock went up. So it'll be interesting to see if the share price can stay that high. But before getting started, I do have to say that I'm not a licensed financial advisor, and this is not financial advice. Anything you hear in this video is just me giving my own opinions on the stock market, and you need to do your own research before making any investment decisions. Also, if you've been enjoying these videos, I really appreciate it. Hit that like and subscribe button, as would help my channel out a lot. Since these videos are going to be a little bit longer, just a reminder that if you want to kind of skip around, or maybe I'm talking about a stock that you don't really care about, I do have timestamps in the description if you want to skip to a stock that you actually care about. So with that out of the way, let's talk about the first stock, which is going to be Boeing, ticker symbol BA. So currently Boeing is trading for $206 and it's down 37% in 2020. Boeing has been one of these stocks that I've identified as being one of my favorite stocks to buy for a long time. However, the reason that I haven't bought it is I was waiting for a couple things to happen. And Wednesday, it's looking like we're finally going to be getting that news. Allegedly, the FAA is going to be announcing that the 737 MAX planes are going to be able to fly again. If you somehow forgot, there were 2 massive crashes that happened with the 737 MAX planes in the past year. And as a result, the entire fleet of these brand new planes were shut down and grounded indefinitely. And so it's been a long time coming for these to be able to fly again. So unlike some of these other airline stocks that have gotten beaten down because of the pandemic, Boeing was already in a tough spot going into the pandemic, and then the pandemic made it even worse. And so while Boeing has been crushed so far this year, being down 37%, the fact that it's above 200, and I remember a time when you could buy it down in like the $80s and $90 range, the stock has recovered a decent amount. With the pandemic really hurting all of the airlines, the amount of orders that Boeing has lost for these new planes continues to rise. The latest number that I could find is that so far Boeing has lost around 800 orders of their 737 MAX planes as a result of the pandemic and the groundings of these planes. But how big of a hit is that? And so when I think of Boeing, I think of them mainly as being commercial airlines. But when you look at the revenue breakdown, it is definitely dependent on the commercial airlines being around 50% of their revenue. But when you look into it deeper, 30% of their revenue comes from defense contracts from the US government. And so I was reading an article talking about how, yeah, that does seem pretty safe, but there's a possibility that some of the spending for defense goes down in the future. And I think we can all agree that's probably not going to happen. Some of these safest contracts you can have come with military spending because the US just spends as much money as possible on defense. And since Boeing's 30% of their revenue comes from that, I'm going to call that relatively safe. And so while all of the airlines pretty much took money from the bailout with the CARES Act, Boeing did not. And while that seems like maybe it's a good thing, maybe, you know, they didn't want to take the government's money, or maybe they didn't need it, it was because they were able to fund $25 billion based off of borrowing. And the whole reason behind that they didn't take the CARES Act is because it allowed them to cut jobs that they wouldn't have been allowed to as part of the requirements for taking money from the government. This is why most of the airline stocks cut a bunch of jobs. I believe it was October 1st when the CARES Act expired. And so Boeing did not do that. They were able to borrow the money and they were able to lay off people, which is going to lower costs for the company. So let's talk about some of the numbers. Boeing posted consecutive quarters of losses after having 40 straight quarters of profit. So this is a huge dip from them. As I mentioned, it's a mix of the pandemic plus the 737 MAX planes being grounded. But the numbers ended up being better than the analysts kind of expected. Revenue has been dropping since the planes are grounded, and getting them back into the air will be great for the company. And the defense contracts have kept their revenue relatively stable. Obviously, it's still a pretty big hit, but that 30% of their revenue being pretty stable gives them a higher floor when it comes to the drop from their revenue. So let's hop on the computer and talk about what I see with Boeing, because I think that's probably the most attractive part about Boeing. Okay, so here we are looking at Boeing, ticker symbol BA, and the way that I'm going to show this chart is I have excluded the stuff that's happened since the pandemic. So this is the beginning of 2020. As you can see, this stock has been incredibly stable over the past couple years and has just increased in price significantly since that point. And then once you get to the pandemic, things just kind of started going poorly for Boeing, obviously. And so I've charted out some areas that I want to talk about because this has been a very technically sound stock for a bit now. Some of the things I charted at the very bottom, and it went horizontal for a bit. It's just crazy to think about. This stock was at around $400 and then fell down to being in the 80s within a couple of months, which is just crazy. Look at all these giant red candles. So it came down here, went horizontal. We got some positive news, and then it's been kind of sliding for a bit. And the thing that I want to point out is we're starting to get some bullish momentum. We've had, this was the gap up from the Pfizer news. This is the gap up from the Moderna news. And at this point, we are getting very close to a very bullish indicator, which would be the golden cross. We're getting the 50-day that's starting to arc up and could pass over the 200. Is this going to mean that it's going to be 100% bullish? No, there's no chance it's going to be 100% bullish. But there is a good chance that things are going in the right direction for Boeing. I've mentioned about some of the positives that we're seeing from the news that's coming out. For the short-term price target, I'm going to have it, I would love for it to fill this gap. I tried to a while ago. So I'll put the short-term price target to 230, and then I'd really love to see it hit 250. But as of right now, I think the charts are very solid. I love the overall stability of the company before the pandemic, and it seems like it's going in the right direction. And from the charts, I'm feeling very good about Boeing, ticker symbol BA. So overall, I think Boeing is in a decent spot for a long-term investment. There's definitely a lot of short-term risk, and I think you could probably say that about most of these stocks. But based off of the stability of the charts, the 737 MAX planes are going to be getting off the ground soon, and some of the positive vaccine news that we have seen, I think Boeing, in my mind, is a buy for my stock portfolio going into 2021. So the next stock I wanted to talk about, it was a requested topic, and it's going to be American Airlines, ticker symbol AAL. Currently, American is trading for $12.75, and it's down 55% on the year. And so I've been excited to talk about American because it's been a long time since I've been able to bash on the company. If you've been on this channel for a little bit, you know how much I dislike American. And since there are a decent amount of new people since I've talked about them, I'm going to talk about why I dislike American specifically, and then I'll talk about why I like some of the other airlines a lot better. So airline stocks have been getting a boost recently because of the vaccine news from the Pfizer and the Moderna. And so they've been getting a little bit of a boost, but obviously with the pandemic, the demand for air travel has been really rough. We've been seeing some stuff recently, and I'm very curious to see what the actual numbers come out from travel going into the holiday season. I've been talking about this with my stock portfolio video because I am a shareholder of Southwest Airlines, ticker symbol LUV. And so seeing the numbers from the air travel this holiday season is going to be very interesting. With the last earnings report, American had some really tough looking news. While American restored to capacity faster than its main competitors in Delta and United, they're still burning through cash like crazy. So United and Delta were two companies that had blocked off the middle seat to try to limit the spread of the virus between the passengers. And American did not do that, or they did that for a bit, and then they opened it back up to try to get more revenue. And so in quarter three, American burned through $44 million a day compared to Delta burning 24 and United burning 21. They also had a net loss of $3.6 billion from the last quarter. But let's talk about why there's plenty of better options out there, and I'm going to make a case for my favorite. And so American brought in 25% more revenue than Delta and United. However, they had a wider loss than the other two. And so what this means is, probably the easiest way to explain it comes from, you can look up the fundamentals, but I'll just give my explanation for net margin. What net margin is the efficiency a company has of taking revenue and making it into profit. And so a company that is more efficient does not need as much revenue to make the same amount of profit. And so we've been seeing that with American, who has a very low net margin compared to the rest of the sector. From the numbers I found, pre-pandemic, their net margin was around 3.5% compared to Delta at around 10% and United at 7%. So even though they brought in 25% more revenue, they had a wider loss because their net margin is significantly lower. So American is very dependent on being the largest airline and having the most amount of routes going. And that's not a great thing with the pandemic that is cutting off a lot of the air travel. And since they're so dependent on international travel, personally, my two favorite airline stocks would be Delta, ticker symbol DAL, and Southwest Airlines, ticker symbol LUV. If you want my full explanation for why I love Southwest going forward and why I'm a proud shareholder, I'll link that above right now. And then the nail in the coffin for American has to do with their debt to equity ratio. And so a lot of these companies have massive debt to equities because they've been taking a lot of long-term debt to have enough cash on hand to survive the pandemic based off of the cash burn that they've been seeing. And so when we look at Delta and United, Delta's debt to equity is 8.8 and United is 3.2, which is very large. But because it is the pandemic, I'm not as worried about that. And then when you look at Americans, yeah, American hasn't had a debt to equity ratio since 2017. And what that means is that they've had negative shareholder equity since before the pandemic even hit. So that is the biggest red flag to me and is a reason why I'll never buy American Airlines. But let's hop on over the charts and I'll talk about what I see there to see if there's any saving grace for a company like American Airlines. Okay, so here we are looking at American Airlines, ticker symbol AAL. And as you can see, unlike Boeing, who was doing incredibly well before the pandemic, American Airlines has been falling for a while at this point. This decline started back in March of 2018. It's just been sliding since then. And one of the interesting things to point out is that the 200-day moving average has been very respected by this stock. It's bounced here, and then it's been struggling to break above the 200 for a long time. You see all these areas where it gets close and just cannot break through it. And then it came up here and it's bounced off of it. And now we're getting to an interesting spot, just like what we talked about with Boeing. As we come in here, the stock has been trying to push higher for a long time. I'll call that a bottom right there. Yeah, that's about all I want to chart at this point. But we're getting to a point where something's going to have to give. It's been horizontal for a long time, but now that the 200 is coming down, we have a lot of things that could happen. It could be some positive news, maybe from some more vaccine news that pushes it above it. But I think if it breaks above this 200 moving average, it'd be pretty bullish. However, I don't feel that great about the fundamentals of the company, so I don't feel comfortable enough taking a position just based off the technicals. I make my trades specifically based off of a bunch of different information, and while the technicals look pretty good and we could have a bullish indicator relatively soon if we get some upward momentum, the fundamentals of the company tell me to stay away. So the next stock on this list is going to be JP Morgan Chase, ticker symbol JPM. Currently, JP Morgan is trading for $116 and it's down 17% on the year. If you've been around this channel for a bit, I have been talking very positively about JP Morgan for the past couple months as being one of the best buys for stocks at a discount, and I continue to feel the same way about it. JP Morgan is the largest bank by market value, and when I talk about buying into beaten down stocks, I always talk about how I always feel the most comfortable buying into the largest in the sector, unless we're talking about American Airlines. But Delta is relatively close, so that's why I feel pretty good about Delta. Because it has the most amount of stability, because they are the largest and they're probably the most secure in their financials. Bank stocks have been beaten down by the pandemic and the fact that interest rates have been holding around zero for like 6 months at this point. Before the pandemic, JP Morgan had 8 straight quarters of double-digit earnings growth, and as the other banks got crushed by the pandemic and prepping by securing loss provisions, JP Morgan did very well with their investment bank side of their business, which is not something that you can say about the other bank stocks. In the second quarter, their investment bank for JP Morgan revenue increased by 91%, while most banks did not get that type of boost. We have been seeing banks prepping for loan losses, and JP Morgan did set aside $10.5 billion to protect themselves back in July. But their last earnings report, they had lower than expected loss provisions, as they made a bigger than expected profit from their investment bank side. And that has to do with, yeah, they made more of a profit. Also, they have more confidence in the recovery of the overall economy. So they did not put as much money aside as analysts kind of expected them to. In addition, the last quarter saw growth with their trading revenue that increased 30% year over year. And here's the revenue for JP Morgan. And as you can see, it's dipped. It hasn't dipped that much. And when you compare it to stuff like Bank of America, which I'll put up right now, and then Wells Fargo, ticker symbol WFC, you can see that JP Morgan has the healthiest looking revenue chart, in my opinion. Overall, I think JP Morgan Chase, ticker symbol JPM, is the most stable bank stock overall, and they're in the best spot going forward. So with that being said, let's hop on over the charts. I'll talk about what I see with JP Morgan Chase, ticker symbol JPM, to see if I can give the final okay to make it a buy, in my opinion. Okay, so here we are looking at JP Morgan Chase, ticker symbol JPM. What I love about this stock is that it has been very stable when it comes to the zones that I've drawn in the past. Last time I talked about this stock was back in it was probably like early September, and I charted out this area as being a spot that I wanted it to break through. And then when I came to the charts today, it came right to that area, and it's kind of bouncing around there. So when I look at this chart, the first thing that kind of sticks out to me is that we have gotten a new high since the pandemic has started. That's usually a bullish sign because we're getting more momentum. You always want to have higher highs and higher lows, and we've been seeing that with the stock. Here's the very bottom, pushes up, it falls, but not as far as before. We get a new high, then we get a higher low, and it went horizontal for a bit, and the recent news from the vaccine has pushed it up, and we have recently gotten a new high. Also, that does is that fills this gap, which has already technically been filled, but since it's been able to hold up here, it feels very good. The next thing I want for it to break is that we have this very solid resistance at around the 118 mark. So I'm going to set an alert in here to see if it can break above that, because if it does, I feel very bullish on it overall. Obviously we're not getting close, but we're getting closer to the all-time highs. So once we break above this area at the 118, it seems like it would be smooth sailing to get up to these highs. When we look at the track record of the stock, it's beautiful. It's similar to something like a Boeing, where it just has a track record of growing for the past decade at least. And so this is very nice for me to look at. And based off the technicals and the fundamentals, this is a stock that I've loved for a long time. I've made plenty of videos talking about it. And if it can break above this 118 area, I will probably buy into the stock because I think it looks great. So next up, I want to talk about Under Armour, which is ticker symbol UA. And so on this channel, I've talked a lot about stuff like Nike. Nike is a stock that I own, and since I do live in the Portland area and I'm like 20 minutes away from their headquarters in Beaverton, I feel like I'm obligated to buy the stock. But I can just look just outside my door, and I run 3 or 4 days a week at the Under Armour corporate headquarters and the corporate track, which is like a block from my house. So I feel like I should talk about Under Armour. Also, it is trading for $14 and it's down 27% on the year. So while the pandemic has been pretty good for a lot of the other athletic wear companies like Nike and Lululemon, Under Armour has really been struggling. After reaching highs in 2015, the company has lost around 80% of its value since that point. A lot of the articles that I was reading talked about how Under Armour has been really behind the curve when it comes to athletic wear, footwear when it comes compared to Nike, and they're just not in a great spot. So Under Armour has around 64% of their revenue coming from apparel. When you compare that to Nike's, is only 27% because Nike makes so much money from their overall footwear lines, and Under Armour does not have that type of success with footwear. Also, another big problem with the company is that they were focused on doing wholesale, which is selling out to these big companies that sell them at a pretty big discount. And so that has been great because it increases their revenue really early on. But since they've been so reliant on them, it lowers their overall profit margins. And then customers kind of think of them as being a lower type of brand compared to a Nike or a Lululemon. But after hitting lows of around $6 during the pandemic, the stock has bounced a lot. And it bounced 14% in September. And that wasn't because of any news specific to Under Armour. There's just a lot of positive news coming from a lot of the other retail stocks that pulled Under Armour higher. Then in October, they had positive trend that came with their great earnings report. And while Under Armour doesn't have the same success with their footwear as compared to something like Nike, the company did see their revenue increase for footwear by 19% in the third quarter. So this is a trend in the right direction. And since it's at such a discount, it did have the stock bounce higher because of that news. And while the pandemic is hurting a lot of companies, this might actually be a positive thing for something like Under Armour. As I mentioned, they kind of had a negative image because of the places that they were being sold. But since people are buying stuff online now, it might improve the image of a company like Under Armour, and they can be a little bit more profitable when they're not going through these wholesale distributors. So going forward, I think Under Armour could be a decent value play. Obviously, it does not have a great track record with its stock price, but it has bounced off of its lows of $6, and it's trending in the right direction. And when you look at the overall market cap, Under Armour's is tiny at $7.4 billion compared to almost $100 billion for Nike and $45 billion for Adidas. So they definitely have a lot of growth, and they seem to be trending in the right direction. But let's hop on over the charts, and I'll talk about what I see there for the future potential of Under Armour, ticker symbol UA. Okay, so here we are looking at Under Armour, ticker symbol UA, and as you can see, things have not been going well for a long time. I was kind of confused why the stock gets shown like this, because I can see the stock price from 2015 when I look in other places, but for some reason TD Ameritrade shows it as IPOing in 2016 when I know the stock went IPO in like 2005. Anyway, so we get this, we had a downtrend for a long time. It was doing decently well through this area, and then it started falling with the pandemic, and it has never really recovered since then. We haven't gotten to that area, but what we've seen is it hit lows twice down the $6 area, which is crazy to think about that it's doubled since that point. But then we've been seeing a lot of momentum going to the upside. And interestingly enough, it has been using the 50-day moving average as a support and a resistance. It was respecting it here as a support, resistance, broke above it, and once it got above the 50-day moving average, it's just been bouncing off of that. and now we have seen a golden cross. So this stock is very bullish based off of the technicals. The area that I'd be looking for it to get to is, as always, I want to see a gap fill. So this is going to be the bottom of the gap around the $15 mark, but to fill it completely, it's going to have to get up to $17 or around $18. So it has a long way to go, but I'm feeling very bullish based off the technicals. The problem is, once you zoom back a little bit, you can see the track record of the stock is not ideal. We do have a couple years going from late 2016 up until, I'll call that right about there, the end of 2019, where things were going pretty well. And so maybe the switch to more online sales and the last earnings report makes me feel very bullish on the stock, but I'm like 50-50 on how I feel about this stock. It definitely has a lot of risk. It has bounced significantly from its bottom, but for a stock that's at a discount, I'm a big fan of Under Armour at this point. And so finally, I wanted to talk about probably the most beaten down sector, and is a stock that a lot of people have asked me to talk about in the past, and we're going to be talking about Carnival Cruise stock, ticker symbol CCL. While I am talking about Carnival Cruise, the stuff I'm saying here kind of applies to all three of the stocks, including Norwegian, which is ticker symbol NCLH, and then Royal Caribbean, which is ticker symbol RCL. All of these companies are in a really tough spot because of the pandemic, and unlike a lot of these airlines that were able to get bailouts and kind of run at maybe 25% capacity, these cruise ships have been shut down for like the entirety of the pandemic, and it has really hurt them. With the two positive news stories coming out about the vaccine, these cruise ships have jumped in price as investors are more hopeful that these ships are going to be able to get out of port sooner rather than later. All these stocks have been burning through cash. Last week, Carnival Cruise announced that they're offering $1.5 billion in a stock offering. Whenever you offer stock, it dilutes the value of all the other shares, and as a result, the stock price goes down. And so that is what we've seen. This is after they had a $1 billion stock offering that was completed October 30th, which is 17 days ago. So they are trying to stock up on as much cash as possible at this point. The company stopped its stock buybacks and dividend back in March to hold on to as much cash as possible. At this point, the company expects to burn through $500 million per month in the next quarter. But unlike airlines, they have not been supported by bailouts by the government. And I've talked about this, it has been a while, but the main thing is that these airlines were able to get financial support from the US government because they are American-run companies that do pay taxes. When you look at all of these cruise stocks, most of them there's some very complicated laws for how these cruise stocks operate. Almost all of these ships fly flags from countries that have very lax labor laws and allows a lot of these workers to be paid at below minimum wage, even though they are operating out of the US. And so that's kind of how they've been getting around the labor laws for a long time. And now that they're in desperate need of cash, the US government did not feel like they should bail them out because they are not operating fully as a US company. And so that's why they've been having to take all of these stock offerings to try to get as much cash as possible. And from the numbers that I was able to see, it appears like Carnival Cruise does have around 1 year of cash to operate without any of these ships being run. And based off of the positive vaccine news, it's possible that they're going to get ships back in the water or out of the port before that 1 year happens. So this is definitely a stock that has a lot of risk. That has a lot of upside because of how discounted it is, because it is down 64% on the year. But with the pandemic ramping up again, unless we get some very positive news from the vaccine, this is going to be a stock that I'm going to be staying away from just because of the overall risk factor. But with that being said, let's hop on over to the computer and I'll talk about what I see with the charts for Caribbean Cruise Lines, ticker symbol CCL. Okay, so similar to some of the other stocks that we've talked about at this point, Carnival has been sliding before the pandemic really even started. We have this all-time high back in February of 2018. Let me go back to see if there is another high. Nope. So that was the high, and then it kind of slid for a while, but it was doing it in a very, tame manner. As you can see, it's not having these giant drops. It's just kind of slowly sliding for a bit. And then when you get to the pandemic, obviously it falls off a cliff. But since that point, it's actually held its own better than I really expected. Based off of the news and how far it's down in 2020, I expected it to be a lot more brutal looking than this. We have a nice support that's been set up around, I'll call that around there. And another interesting thing is, since it's been down for so long, the 200-day moving average is catching up. We do have the 50-day, which it's pretty much flat at this point. But we've had the positive news from the vaccine, and then it slid, positive news here, and if we can get above that, might be bullish. I'd have my price target to be this little gap fill right here, which is also going to be a resistance up at the $25 mark. So that has a long way to go. Obviously, based off of how this business is running right now, it's a huge risk, but it does have a lot of upside, and it's a stock that's at the biggest discount that we've talked about in today's video. So overall, those were 5 stocks that are at a significant discount still in 2020, and I gave my opinions on all of them. And so far, if I had to rank my favorite, I would go my favorite being JP Morgan, then I would go Boeing, then I'd go Under Armour. It hurts me to not put American Airlines last, but I will put American Airlines fourth, and then I'll finish it up with Caribbean Cruise just because it has so much risk associated with it. So thanks for watching this video. Let me know what stocks you guys would like me to talk about in a future episode. Thanks for watching, and I will see you tomorrow.